All right. Hi, everyone. Thanks for joining us. My name is Brandon Hughes. I'm the Arizona Division Manager with Asset Preservation, Inc., also called API. We also have our Senior Vice President, Scott Saunders, with Asset Preservation. He speaks all over the country, and he's helping us out today. First off, I want to send a big thank you to our sponsor and host, you guys, USA Realty. And we also really want to thank you guys for the flyer you put together, because that was probably one of the best I've seen in this new age of Zoom calls and webinars. All right, without further ado, I think we're going to have Scott lead us into it with some terminology.
Excellent. Hey, good afternoon, everybody. I'm actually speaking to you from just south of Denver, Colorado, so it's noticeably cooler than Arizona. Today, I woke up to a little bit of snow coming down, if you can believe it or not. And, you know, one of the goals we want to do for you this afternoon is give you an overview of 1031 exchanges. We want to give you an update of some recent changes that affect some of the time deadlines. We want to talk about things that will help you put deals together, particularly things like second homes and vacation homes. We want you and your customers to have a really good understanding of the basics of 1031, but we really want to give West USA real estate professionals an edge over the competition. So that's what we're going to do today. And as Brandon kind of alluded to, as we start off here, we're going to start talking about the terminology. And the reason is there are just some buzzwords out there when it comes to 1031 that, you know, you hear and they're not, you maybe don't know what these terms mean. So I'm going to go through this terminology fairly quickly here. And, but I want to cover some of these different terms that are there. So let's just take them, we'll run through it. Boot. You hear that a lot with 1031 exchanges. And let me give you the simple definition. Boot is simply defined as non-like-kind property. And when we talk about boot, there are two different types of boot. There's cash boot, so that's cash your client takes out of the transaction. Or there's what we call mortgage boot, which is later down on the list. That one's a little trickier. It's where your client has a lower amount of debt on the property they purchased, they go into, from the property they sold. So simple example, they have $100,000 of debt on the property that they're selling, but they only take on $80,000 of debt on the replacement property, then they have $20,000 of mortgage boot. And mortgage boot is taxable, just like if you put the cash in your pocket. So you'll see a little bit later, we'll talk about something called the exchange equation. You look at the total cash boot plus the mortgage boot, and then that's the total amount of boot that you have. Constructive receipt. This is something that we just want to touch upon. And by the way, you know, I'm speaking today. Brandon's going to hop in and out a few different places. He's a tad under the weather, so I'm going to do the heavy lifting today. But you do have a local expert with Brandon Hughes. He's an accountant by background right there in Phoenix, and he wants to just be a resource to you and your clients. Anytime you got a question on 1031, give him a call, loop him in on a conference call, whatever it might be. Constructive receipt. This is when your clients are legally entitled to the money in some manner, and mostly where it comes up is when somebody closes and they just leave the money in escrow, right? So they close it out, they leave the money with the escrow company, the title company, and they say, I haven't touched it. The problem is the IRS doesn't look at it that way. If you close a transaction and you have the money, then in that case, you know, even if you haven't taken it, you have cashed a check, but you close it, you're a seller on a settlement statement, you now have a taxable sale, and it's too late to go back and set up an exchange. So one takeaway for everybody on this call is that you can set up a 1031 anytime you want. It just has to be before you close escrow. Direct deeding is the direct transfer title from the investor to the buyer, and then from the seller back to the investor. The exchanger, we'll call them the exchanger, the investor, the taxpayer. They're just all synonymous terms. Exchange agreement. This is the document. It's got a whole bunch of pages in it that says you're giving up X amount of property, and you owe, and the qualified intermediary, the entity facilitating exchange, owes that amount of property or money back in a certain period of time. The exchange period and the identification period. Now, we're going to give you the general principles, but right now, in May of 2020, we've got an anomaly because we've got some extensions on this time period. So exchange period is the total time from when you close escrow to when you have to buy. And it generally ends 180 days out. It can be a little bit shorter, and we'll discuss that, and now it can be a little longer. The identification period is the period of time you have to identify multiple replacement properties. Generally, it's 45 days long. Right now, it's a touch longer. Like-kind property, so much confusion on this, but essentially like-kind property is just any property held for use in a business or held for investment. So it could be single family for land, for commercial, for industrial, for shopping center, all those are like-kind. Mortgage boot we touched upon. The entity that facilitates the actual exchange is called a qualified intermediary by the IRS. You'll hear Brandon and I refer to it as a QI just because it's a mouthful, but sometimes you may hear it called an accommodator or facilitator, also synonymous terms. Finally, the relinquished property is the property you're selling, but some people might call it the phase one property, the sale property, or they may actually call it the down leg property, particularly investors from Southern California. Replacement property is the one being purchased. That one is going to be called the up leg property, phase two property, or the target property. Now on the next slide, I just want to show you a couple different tax code sections. Not sure why I'm losing my camera there, but we'll just go through it. 1031 is the focus of today's class. Involuntary conversion is when a property, maybe it's through a hurricane, it could be through a fire, anything like that, where it's converted and you've got different rules. You don't need a QI. All of you as real estate professionals, I'm sure, are familiar with 121. It's a primary residence rule. So live in a property 2 out of 5 years, you can exclude up to 250,000 single, $500,000 married, filing jointly. 453 is another tax deferral mechanism. So as you receive money, you have to pay taxes. So you basically self-finance it. Sometimes called seller finance or the installment sale rule. You sell it to a buyer, and then they pay you interest and then maybe a principal 5 years down the road. So it's a deferral mechanism, but you're still going to end up paying all the capital gain taxes. And then last one, for anybody, if you stumble into a commercial transaction, there's a whole nother provision in the code called an UPREIT, or section 721 of the code, where you contribute your property to a REIT and they give you what are called OP units. So with that, Brandon's going to talk to us a little bit about capital gain and what that's all about.
All right, thanks, Scott. Yeah, so we're going to jump into my background here, take a look at capital gain taxation, because this is an area where a lot of investors, they don't fully understand the taxes they potentially might face when they're selling that appreciated property, that relinquished property. So there are 4 different levels of taxes, as you can see on the slide. First, they're assessed on any depreciation recapture, and that's at a pretty high rate of 25%. Now, we also have federal capital gains taxes. We're going to talk about those in a bit. It's at 20 or 15%. We're going to go over the different thresholds for that. We also have what we call the NIT tax, or the net investment income tax, 3.8%. And then we have our applicable state tax rate. And with this, we're pretty lucky in Arizona. It's not too bad, 4.5% about, but we see a lot of people who they might be exchanging out of California, where it's a 13.3% tax. And so this is where 1031 exchange becomes a really powerful tool to make sure that you're not hitting potentially all 4 levels of these taxes. Let's jump to the next slide and look here at, all right, so this is the big one. This is the federal capital gain tax, and this is the one that people probably think about or they jump to when they're going to sell a property. And this is the one where we said it's 15 or 20%. If you hit the higher margin here of 425, 800 for a single filer, you're going to be in that 20% bracket. You're thinking, well, I don't make that much. My clients don't make that much. But what about when you're selling your property? That's included in his taxable income. Also, for the married couples filing jointly, we have 479,000. If that looks a little odd to you, it's because in this case, there's a marriage penalty that the IRS imposes. At least that's what we call it. We would expect that if you're married, it would be double what single filers hit the threshold for. But for us, it hits at a much lower threshold. And it's going to be the same here for the net investment income tax. So this came about around Obamacare back in 2010. This is important in that it's only for net investment income, and it only applies when you exceed the threshold of 200,000. And again, we see the marriage penalty here, 250,000. And I think that's it for taxes. Are we on to wholesale and exchange?
Yep, we sure are. So your clients, and I realize a lot of you deal, may focus primarily on single family residential or single family homes, but a lot of investors, in fact, the majority of investors start with single family. I'm a big single family investor. In fact, I've had property currently in Arizona, and I've owned numerous properties there. But your clients, when they've got property, really only have three options available to them. They can hold the property, and that's great. A lot of people hold for the long term. Very, very common for that to happen, be a buy and hold. But the only thing I want to mention is if you have somebody that's in a part of the state where it's just not growing, there's not a lot of job growth, not a lot of economic activity, they might be missing out on significant upside down the road because they're not going to see appreciation or rents go up. Now, the second alternative is certainly to sell, pay all the taxes. So you pay all the taxes, and Brandon went through it very well. You have 4 different levels of taxes. You have to pay all 4 of those, and then you get the net equity. The challenge from just a pure investment perspective is that after you pay all those taxes, you've got a lot less money left over than the gross amount. It's very difficult to get the same return with the net equity versus the gross equity with funds that are invested outside of real estate. So yes, there are reasons why people may want to not exchange and sell and liquidate, but from just a pure investment perspective, it can be a little problematic. Now, the third option is to do a 1031 exchange. And you can do a fully deferred exchange, but I want you to know a whole bunch of our clients, they obtain partial tax deferral where they get a little bit of money, but they also buy 1 or 2 replacement properties. So just keep in mind, a 1031 exchange is not an all or nothing proposition. You can do partial tax deferral, and something like 30 to 40% of our customers get partial tax deferral. So it's very, very common to do it that way. Very, very common. All right, next slide. The code itself, and I'm just going to go through this really fast. It says, no gain or loss shall be recognized on the exchange of real property held for productive use in the trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So some takeaways. When we look at the very first line there, we call it non-recognition treatment. So this is not a tax-free exchange, it's a tax-deferred exchange. So the tax liability is following that investor from one property to the next and the next. So sometimes we hear the term tax-free. It's really kind of a misnomer in that regard. Now, the types of property that can be held, very broad. You could do a business for business, investment for investment, investment for business, business for investment. We'll get into that a little bit more details to what that actually looks like. Now, when we look at things you can't exchange, stock and trade or other property held primarily for sale. So stock and trade is going to be inventory held for sale in the ordinary course of business with customers, but other property held for sale, does anybody know what that might refer to? It could refer to like a fix and flip maybe. Somebody gets a good deal, they turn it around and put it right back on the marketplace. The fourth bullet point down is something to keep in mind. So you can't exchange out of a partnership interest or into a partnership interest. Neither one of those are allowed, which I know you're thinking, well, a lot of people own property in partnerships and LLCs. How do they do an exchange? So we'll talk about that in just a few minutes, actually, not too far away. The first thing we want to talk about is how do you look at whether property is being held for sale or for long-term investment? And the IRS doesn't have what we call a bright line test. They're going to look at the overall flavor of the transaction. Did it tend to look like it's being held more for investment or more for sale? So things that they can look at. The property, how was it held when it was acquired? How was it held later down the road? How was it being held at the time of sale? The extent to which improvements are made on the property. So if somebody gets some land and they cut in roads and utilities and do all that, they look like somebody's maybe going to be a dealer or developer selling off lots, not holding for investment, which is generally rental income. Frequency, number, and continuity of sales, the extent and nature of the transaction. Next one is important, the ordinary course of business of the taxpayer. So if you got a client that's maybe a dentist and in 1 year they turn over 2 properties, but they get most of their income out of their dental practice. That's a very, very different fact pattern than maybe a real estate professional or somebody who actively develops and does those types of things with property. And then the last 2 can trip your clients up. The extent of advertising, promotions, or any active efforts to obtain a buyer who was going to purchase the property, or the listing of the property with you as a real estate professional. So whether it's something you do a lot of, if they turn around and then they're going to get a property and then immediately list it with you, it makes it look like it may not be held for investment. So that's kind of a quick overview. Again, everybody's situation is going to vary. So give Brandon a call with your clients and he can kind of walk you through what your situation is. We've got a whole stable of maybe 170 things that we call templates, but a lot of answers to questions that customers have. Okay, let's get into the issue I kind of brought up a few minutes ago. What happens when you have a partnership and some partners want to sell and pay the taxes? Others want to do a 1031 exchange. Well, I already told you can't exchange out of or into a partnership interest, right? That can't be done. So you've got to find a way to get it out of a partnership and now have 3 tenant in common co-owners. So when we look at the different partnership issues, it's basically making sure that it's no longer a partnership interest, it's just an interest in real property. And then the way this can be done, there are 2 different ways to do it. You'll see the first one is called drop and swap. The second is called swap and drop. So let's address the second one first because it's much rarer. Under a swap and drop, so 1031 followed by dropping out, partnership stays intact, buys a replacement property, all as part of an exchange. After closing down the replacement property and holding it for X amount of time, you're then going to distribute the ownership interest in the departing partners side of things. Drop and swap, by far, way more of these are taking place. This involves the partnership deeding out of the partnership and into the various tenant and common co-owners. So if Brandon and I and one other person, let's just say, we'll call him Jimmy. So Scott, Jimmy, and Brandon, we each a third of a partnership. Now the partnership, if it stays intact, can do an exchange. So any entity can do an exchange. C Corp, S Corp, partnership, LLC, doesn't matter. Where it gets trickier is I want to cash out, Brandon wants to do an exchange. There's a way to do this. I can get the money for my portion of it, right? I can get the money for my 1/3 interest, set up an exchange, do an exchange into like kind of replacement property. So it can be done. The big issue that comes up is the period of time. Do I drop out of my partnership and deed it to these other entities so I can hold an interest in real property? Do I do it right before the exchange, or do I do it
Hey, Scott, your audio might have dropped off.
Sorry about that. Audio better? I don't know how I did that. Thanks, Brandon. Sorry, I don't know what happened there. So this is a real important issue. The earlier you can get it out of the partnership to where you now hold it as tenant and common co-owners, the better off it's going to be. So just keep that in mind with your clients that own in partnerships and in LLCs, that's something they want to kind of keep in mind. You've got, in this case here, you've got a whole bunch of federal cases that are very taxpayer friendly. In a state that really is a vital partner with Arizona, California, the rules are a little stricter. So the Franchise Tax Board in California has taken the position that the federal tax court cases don't apply to them. So many people, and everybody's familiar, there's a trend of people coming out of the West Coast where equity is a little bit more and they've appreciated more, and they're buying multiple properties from you in Arizona. So just be aware of that when you're dealing with a customer out of state. Finally, there are changes that were made to the tax form back in 2008 to make it easier to detect this. Now, the next one's something you may not think about, but The tax owner that relinquishes a property has to be the same tax owner who buys the replacement property. Where things can get a little tricky is, let's say you've got a couple that maybe they're divorced, they get remarried, and they have their sole and separate property, but they want to get their new spouse onto the new property, and they say, well, they're not on it. We're going to close in a week. What about just quit claiming and adding the spouse on there? That would be a problem because you want to hold it for investment. And we'll get into later what that holding period is and what it looks like, but that could be a challenging issue. So you got the general principles. Now, you can also go into some entities like an LLC that the federal government calls a disregarded LLC, meaning for tax purposes, everything flows down to the owner of the LLC. It's not really a separate entity. So that's something you definitely want to keep in mind. So look at how you're taking title to the new property, look at how you're taking title to the property you're giving up. Now, what I want to do is you're going to start to see all these different images come on screen. I'm going to go through a few of them very quickly, but there are some super creative things you can do. We've done lots of exchanges on easements and things like that in Arizona, but all these images are images of what we call like-kind property. So like just means investment for investment or business for investment. It doesn't mean that it has to be the same type. So you can come out of a rental home and go into an interest as a tenant and common owner in a fourplex. All of these are considered like-kind property. There's some things that are pretty unusual in there. You see sell and has a whole bunch of things. The only thing that's not like-kind is property you're going to sell and your primary residence. Other than that, it should be like-kind property. Now, keep in mind, when we look at something called air rights or transferable development rights, those are very popular in New York. We got the ability to add to your building. These qualify as like-kind property. I already touched upon easements, but agricultural easements, conservation easements, any easement can potentially be exchanged. So one that's becoming more and more popular that we wanted to highlight for you, a perpetual communication easement, or more commonly known as a cell tower is another one. Energy. I don't think energy is super, super hot right now. We all know the oil supplies were piling up, and we had actually negative pricing on oil, where people were literally, businesses and investors were literally paying you to take the oil off their hands. Well, if it's a royalty interest, it can qualify for 1031 exchange. If it's a production payment, it does not qualify. Now, this one's an important one for Arizona. RevProc 2008 created a safe harbor. So if your client's property is a pure second home, they never rent it, never have rental income, never been rented out, it may not qualify. In fact, it generally won't qualify for this revenue procedure. So it's only a RevProc for people that have vacation homes that they came up with some certain criteria. So the easy way to remember this one is it's the rule of twos. So your client has to hold the property for 2 years. They have to rent it out for 2 weeks each of those years. And it's the last one that's a kicker. Nobody likes hearing this. The personal use can't exceed 2 weeks or 10% of the time that it's rented. That's the trick of that one there. So that time, sometimes people go, oh, I'd like to do that. So just 2 years, rent it for 2 weeks each year, no more than 2 weeks personal use. But you can provide, a great service to your customers at West USA by letting them know that certain vacation and second homes can qualify, and you can get tax deferral on it. It could be very, very helpful. Finally, there's one you may have heard about called fractional ownership. That's where you buy a bigger building and you slice it up into small pieces. And those are called TICs. Now they're called DSTs. These are very popular. They're a great way to go passive. So the advantage is relatively passive ownership. The disadvantage, well, at the end of the day, you're still buying real estate, and you still have to do due diligence on who's going to rent that real estate. And there are a whole bunch of other things too to consider. So if you want more information, adisa.org is a great source. Now what I want to touch upon is a question Brandon and I get all the time. The question goes just like this. How long do I have to hold a property before it's considered held for investment? And I'm going to give you the honest answer to this one, which is there is no holding period at all in the tax code, none. So you just have to have the intent to hold for investment. Intent is the most critical thing, not what you actually do. So intent's super, super important. The IRS is going to look at, when they look at these types of situations, they're going to look at everything, all the facts and circumstances of an investor. And the holding period is important, certainly, but it's just one factor amongst a whole bunch of other issues. So you'll see the case here, the reasoning versus commissioner in 2012, they only held it for 8 months, and yet it was considered a valid 1031 property. So that's something just to keep in mind. Looking down here, see, you guys feel free to ask questions along the way. We'll kind of periodically check it. I don't see anything in the chat thing that's come over yet, so we'll just keep on rolling here. What I want to do is I'm going to hit one more topic, and then I'm going to hand it back to Brandon to talk about the delayed exchange, the timeline, and then I'll talk about the recent COVID extensions. But something that's very simple, but yet people don't necessarily understand is, what do you need to do to get full tax deferral, 100% tax deferral? So number one, you need to reinvest all net exchange proceeds. So that would be after your real estate commission, the title company's fee, recording, all that. So you reinvest all net exchange proceeds. Number two, have the same or a greater amount of debt on the property you sell to the property you buy. So if I have $500,000 debt here, I want to have at least $500,000 of debt over there. So let's give you some examples to kind of flesh this out. Somebody sells a property for $900,000, their debt's $300,000, and all the closing costs add up to $60,000. Net equity is $540,000. Well, they decide they want to buy for $1.2 million on this one. So their debt goes from $300,000 to $660,000. So they're up on debt. Their net equity, $540,000, right? Stays the same. There's no boot in this particular one. So this is an example of 100% full tax deferral. That's really what this is just showing you what you need to do to have 100% deferral. Now the next example here, after this one, remember we talked about boot? Cash boot is cash you take out, mortgage boot is reduction in mortgage liabilities. Let's look at an example here, which is kind of interesting. Taxpayer is going to sell for $900, but they're going to buy for $700. So they go up here, they're going to buy for a lot less. Well, you know already there'll be some taxes. So in this case, debt was $300, now it's $260. Net equity was $540, now only $440. So there's small amount of boot, $40,000 of mortgage boot, plus all the cash boot. So you can see there's over $100,000 of cash boot. Add those together, and that's going to be the total boot that's going to be in the transaction. And with that, Brandon, I'm going to turn this over to you, I think, to talk about the delayed exchange process.
Sounds good. All right, so armed with this knowledge from Scott, we're going to work through just a brief overview of the delayed exchange. This is going to test your memory from some of the terminology we went over earlier. And also, it's going to help keep us from getting slammed by those 4 different levels of taxes we talked about too. So at the top, you might remember this, we have the exchanger. So there, all right, exchanger. So that's what we're going to call them. The IRS views them as the taxpayer. For you, this might be your client, or it could be you. So then what are they going to do? Well, if they're not doing a sale and a purchase, in this case, they're relinquishing a property and they're going to replace it with something else. So what do we have? It's been direct deeded to the buyer. So the buyer's acquired their relinquished property. And at this point, this is the start of the exchange. We're going to go over the time requirements on the next slide, but this is at the close of escrow crux. Like, this is the initial start of the 180-day exchange period. At this point, the net proceeds that Scott was talking about, these are sent over to the qualified intermediary, QI. And we hold these until they can be transferred to the seller of the replacement property. At that point, on the close of escrow, same thing, but goes to the taxpayer. And this is pretty much it. It's the quintessential delayed exchange, and probably 95% of the exchanges we do are the delayed exchange. This one's the basic. So there are a couple different time requirements that you do need to hit and adhere to when you are doing this exchange. The first one, as we talked about, when you're relinquishing your property, you start the timeline. From that point on, you have 45 days to identify a replacement property. There's different identification requirements. We're going to talk about those a little later too. But you need to identify to us by midnight of the 45th day. Now we also have the 180-day period, so this would be the 45 plus, say 135 days. That's the amount of time, 30 days, that you have to finish your exchange. And same thing needs to be completed by midnight of the 180th day. So close of escrow on the first relinquished property, then you need to close of escrow on your replacement property. I think now we got deadline extensions that have recently been put out by the IRS and are applicable now. Take that, Scott.
Got it. Thanks, Brandon. Thanks for the setup. So, we won't beat a dead horse, but every part of business has been affected by this COVID-19, including real estate. We're all feeling it. I will let you know, I'm here in my office in Colorado. I got back to work last week. My county was opened up, and Denver opened up this week. So we're starting to trickle back to life. However, you can't really do an exchange very well when you can't see a property. I mean, we've all gone to virtual tours, and I think for real estate professionals, we'll see, all the PPE incorporated in for the recent, next time period. But the IRS brought this out, and they issued what's called Notice 2020-23. So it provided an extension for affected taxpayers. And so this is a national disaster. It applies essentially to the entire country. So let's talk about what it does. If your 45 or 180-day period, if it's gonna end before, so this time period between April 1st and July 15th, you get an extension. So let's say your 45 days was April 2nd, it's automatically extended to July 15th. 180 days the same way. Now the trick is you have to have either your 45 days or your 180 fall between those time periods. We don't have guidance of anything before this or anything after. Now we've got a lot of questions. Brandon and I get questions all the time on this. I think, and this is my theory, I've been in the business for 32 years, but I spent a lot of time on matters in DC. I just think really what happened here is there's so much going on so quickly that the IRS just didn't have the manpower, the people power, whatever you want to call it, to do a lot of analysis. They tried to provide some relief for people. They weren't able to answer every question. Now, we believe that investors who don't want these extensions, maybe because they want the money, can also opt out of them. So what I want to do, a couple of simple examples. Somebody's relinquished property closes on April 5th. The 45th day is May 21st. So the 45th, let's see, look at that. The 45-day identity is May 21st. It's now extended to July 15th. But they're still going to have to close on their replacement property within 180 days. The second example is one where somebody's exchange closes in mid-January on the 16th. Their 180th day would have been July 14th. They now pick up one extra day. So the takeaway for you is, yeah, we got some guidance on these particular issues. We didn't get what we get in a lot of other cases, which many times when we get disaster relief for things like wildfires and hurricanes, the IRS will automatically add 120 days. So our input to everybody right now was realized up until July 15th. We've got a little window here. Then we go back to the normal rules. So I guess what I want to do, just make sure we're clear on that. The chat bar, I'm not seeing any questions. I'll go down to the question bar here and just see, are there any questions on either one of these issues? Oh, I am seeing some questions coming in here. So let me go through. Yes, this is being recorded for future viewing. Brandon, a client wanting to sell a few properties and they want to use a 1031 for the next purchase. I'd like to talk with you after. Okay, so Holly, you guys can connect. That'd be great. I purchased a vacation rental property on my 1031. I rent it out and hold it for 2+ years. After 2 years, can I move into it as a full-time resident? So this is a great question. Really glad this was asked. Yes, you can do that. So you meet the requirement of holding it for 2 years, rent it 2 weeks each year, personal use. And then you can make it a full-time second home. You can move into it as a resident. So yeah, we've got flexibility. You can always change your intent. Great question. And by the way, Brandon there locally would welcome calls like that. If it's your situation or clients, just ask them. We've done as a company over 190,000 exchanges. I've been doing this for 32 years, right? I've written books on this and a couple hundred articles on it. We're a great resource. So what we want to do at Asset Preservation is we want to be a resource to you at West USA, be a 1031 resource for you and help you put deals together. Your client saves money. And guess what? You make more money because you put a deal together. Even better, a lot of people are going to buy replacement property with the same professionals. So you make a commission on the sale, you make a commission on the purchase, and most of the time they're going to go up and buy maybe 2 properties or maybe a bigger property. So you make a bigger commission. So 1031 is great for real estate professionals and it's great for investors. Everybody wins. By the way, it's been a part of the tax code since 1921. So you're not talking about something that's risky at all. It's been in the code for a long time, and we've got a lot of guidance. So back to the disaster here. Just make a decision. Our input would be with what we know now. Now, if we get more guidance from the IRS, and there's a chance we will, make sure Brandon has your email address. We will get the new information out as fast as we can to everybody. Brandon, you want to go through the ID rules and how to identify?
Yeah, so I was talking about these a bit ago. With 45 days, your identification period, well, this is where you'd identify the replacement property for a delayed exchange. So you got to fit within one of these 3 buckets. The first one's probably the most popular. It's the 3 property rule. Taxpayer can identify 1, 2, or 3 properties, and these can be of any fair market value. Now, if you don't fall within that rule, say you're going to identify 4 properties, which I was just working with someone on, you fall into the 200% rule. So with this one, you can identify an unlimited amount of properties or number of properties. However, the aggregate fair market value of the properties identified cannot exceed 200% of the fair market value of that property that is relinquished. So between these 2 rules, I think most exchangers, they're going to fall within one of those. There's also the 95% rule. It's, I don't know, maybe the black market rule or something. Not a lot of people are going to use this one because with this rule, you need to close on 95% of the property to identify. So let's say that you have someone exchanging into 10 properties and something goes amiss on just one of those properties and they're only able to close on 9. Well, 9 is 90%, not 95%. So in that case, they've ruined their exchange and they're going to end up paying capital gains taxes and getting probably slammed if they're in that many properties. So when you're doing these identifications, typically we want them to be made to the QI. They need to be made in writing, unambiguously described. Basically means maybe the address. I was just doing an exchange for someone where there was no address because it was a piece of land and no roads or anything out there yet. So it was a legal description of the land. We also have, it needs to be hand delivered, telecopied or otherwise sent. We've had someone write it out on a cocktail napkin, put it in a PDF, send it over to us. And again, it needs to be sent before midnight of the 45th day.
Excellent, excellent. Thanks for walking us through that, Brandon. What I want to do on the next screen is just touch upon the basic exchange. 95% of them are going to be these what we call delayed exchanges with these 45 days to identify and 180 to close. There are other ways to do things. So a reverse is where we buy the new property first before selling the old one, before closing escrow on it. And I actually did a reverse exchange years ago into Arizona personally. I do a fair amount of single family rentals. I bought a replacement property. It was a model home. And then I later sold the property, it's a model home in Buckeye, sold the property in Surprise. And then I went out and followed my reverse exchange with the delayed and bought out in Maricopa. So it's a great tool. Another thing is you can do an improvement exchange, build from the ground up or refurbish an existing. And then finally, a reverse improvements where you buy the new property, you build something, and then you sell your existing. So sometimes we see owner users doing that. Anytime you do an exchange, your client's gonna have to fill out the form you see here called like-kind exchanges or IRS Form 8824. So they're gonna have to identify the date they identified their property, when did they buy it, all that sort of stuff. What we did is we put in a few slides for those of you that have heard about or get questions on what is called a qualified opportunity zone. I call it an OZ because I'm lazy, I abbreviate it, but there are some things that you can do to combine an opportunity zone with a 1031 and things that won't work. So first one thing that works is you can set up a 1031, not identify property. So you tell the qualified intermediary on day 46, I didn't identify anything. I want to get my money back. Then they get their money back. They then have 135 days to now take that money and put it into a qualified opportunity zone. And the very last bullet point is an important one. When you do an exchange, remember a few slides ago, I was telling you about the exchange equation. Full tax deferral, you got to reinvest all that equity, same or greater debt. With an exchange into an opportunity zone, you just need to reinvest the gain. So this is definitely a benefit. Another way you can do it is you can do an exchange with an entity, can't be disregarded, it has to be a regarded entity, buy a new property, and then maybe syndicate money, bring in new capital and improve that. So it's a 1031 followed by a qualified opportunity zone. And then finally, the last option is you sell something, you put some of the money into a 1031 exchange, some into an opportunity zone. So you can split it up and allocate it any way you want. A couple of things you can't do, two things. Number one, you can't go and put the money directly into an opportunity zone fund because it's a fund of money. It's not actually like-kind real property, so it doesn't qualify. The other one, and this is a little tricky, but if you identify multiple properties but only buy some of them, subject to the 1031 exchange rules, the money has to stay there for 180 days. It can be released on day 181. Well, the opportunity zone rules in most cases only have 180 days. So this one also really doesn't work that well. Now, something that's super important, I've been doing this since 1988, is doing due diligence on the qualified intermediary that you select. And what I want to do is I just want to give you some questions to ask whoever you're recommending to your clients. There have been a number of pretty good sized bankruptcies and defalcations. There was one in Las Vegas, it was about $100 million. There was another one that involved somebody called the 1031 tax group nationwide, 6 different companies. That was a $132 million loss. And that owner of that company was a crook. He took other people's money and he spent it on yachts and aircraft and cars and everything else. He actually is the subject of a video series. What's it called? Now I can't remember the name of the series. Whatever that one that investigates fraud. He's serving a 150-year prison term in Florida. And then finally, the biggest one, $420 million. So 1031s are great, and we want to be a resource to you, but here's some things to look at. Number one, does that QI offer the written backing of a large creditworthy entity? So there are some banks that are in the QI business. So Wells Fargo's one. I'm going to assume a big bank has a subsidiary. You got somebody to go after. Most of the major title insurance companies have a qualified intermediary subsidiary. So our parent company is Stewart. So that's who we're there. What's their financial rating, balance sheet? Next one's really important. Make sure the QI does due diligence on where they're going to put their funds. You don't want to be a big depositor in some local small community type bank. Now, on the next slide, I'm going to give you the number one consideration to ask and to be aware of before you recommend a QI. Do they have a separate segregated account for each taxpayer? You don't want the money commingled. You want a separate account for your client that requires their signature to open it up along with the QIs and to move money out. Certainly QIs can offer qualified escrow and trust account services, normally at a fee. You want to find out what sort of bond coverage they've got. And just kind of wrapping up here, and I'm going to go through the questions one more time. If you have questions or there are things that we haven't addressed, feel free to go either into the question or the chat bar. Either one works. But what I want to leave you on right here, and then I'll let Brandon kind of wrap it up, is that we really, we spend most of our time answering questions, whether it's by email or on the phone. That's what we do. And we want to be a resource to West USA Realty to do that. Brandon's there locally. Brandon, why don't I let you kind of wrap things up there?
Yeah, of course. So we have my contact information here. I also threw Nick's up there, just so we have both. But definitely give me a call, my direct number. Send me an email. My email's there. Also, if you just want to talk to someone at corporate, just you have some questions, there's also the corporate number down there. It's kind of fun. It's the 282-1031. I like the 1031 at the end there. we'd love to be a resource. We've gotten pretty good at this. Whenever I have questions, I go to someone like Scott, and we've seen everything at this point. It's great stuff. It's a really fun job, a really fun place to be. We also, as he was talking about, we've got all those templates, all those forms. So if someone comes to you, they have a question, you can all of a sudden look to your client like an expert in this area. Because what you can do is ask us the question, we'll send you the form, you can pass it along, put your name in there. And that's something we see a lot of people do. Really useful.
So there you have it. Call 833-756-1031 to get Brandon locally. Are there any questions that you've got? I'm watching both the chat and the question one, but feel free to pick our brains. That's what we're here for. I don't have seen any come in. Does anybody have it on the audio side, a question they want to ask on anything? All right. Well, you know what? Thank you so much for your time. Hopefully you got a lot out of this and you got some new things that you can bring to the marketplace to help you personally and your clients put more deals together. So thank you very much for your time. We really appreciate it. Thank you.
Thanks, guys.